Everyone is talking about the big names in gold reserves. China, Russia, the usual giant players. Almost nobody is talking about the quieter central banks that may actually be telling you more about where the reserve world is going. That is a problem because the small and mid-sized buyers are often the ones signaling the shift before the mainstream narrative catches up. And if you only watch the giants, you can miss the pattern forming underneath. I am recording this right now from Phoenix. And I want you to comment what day and date you are watching from, because I always love seeing how far these videos travel. And I want the timeline to be crystal clear because this story moves fast. And real quick, if you value this kind of breakdown, do me a favor. Subscribe and comment Fin Talk OG so the algorithm knows you want more of this. Now, here's the popular narrative. If a major reserve country is not making a dramatic move, then official sector gold demand is probably not that important. Almost nobody is talking about the overlooked reality. A long tail of smaller and mid-sized institutions can matter more than one giant headline because it tells you the logic is spreading, not just concentrating. That is the part that deserves your attention. So let us start with what we can verify. Recent official gold demand reporting shows central bank buying remained historically elevated even with gold trading at very high levels. More important, the buying was not just one country. More than 20 institutions added meaningfully to reserves, while a smaller cluster of 7 did most of the heavy lifting. That combination matters. You had leaders, yes, but you also had a long tail. Poland, Kazakhstan, Brazil, Czechia, Azerbaijan, Turkey, others quietly adding at smaller scale. Let me be blunt. When a lot of different institutions with different political systems, different reserve starting points, and different domestic priorities all keep moving in the same general direction, that is not noise. That is pattern recognition. Here is the clean way to think about it. The small central banks are not interesting because they are powerful individually. They are interesting because they reveal what kind of logic is becoming normal. Big players can always be explained away. People will tell you a giant country bought gold because of strategy, rivalry, sanctions, or domestic politics. Fine. But when a range of smaller and mid-sized institutions also buy, the excuse gets weaker. But that is like sitting at a poker table and realizing not just one player, but half the table has started stacking the same chips. At that point, you stop asking who is bluffing and start asking what everyone else sees. Now, here is the skeptical alternative. Could some of these smaller buyers just be making cosmetic reserve tweaks? Sure, some additions are modest, some are opportunistic, some may reflect country specific portfolio changes more than a global thesis. And I'm going to say something that might annoy both sides. The gold bug, who treats every tiny purchase like a global monetary revolution, is exaggerating. The skeptic, who ignores the long tail because each buyer is small, is also exaggerating. The right way to read this is cumulative, not theatrical. A single mid-tier buyer does not change the world. A geographically broad pattern of mid-tier buyers changing behavior over and over again absolutely can. Here is what nobody wants to say. Smaller central banks often give you a purer read on reserve incentives because they are not trying to manage the same level of geopolitical theater as the superpowers. They are often reacting more directly to practical concerns, crisis resilience, diversification, confidence, reducing concentration risk, preserving optionality. In other words, they can tell you more about what reserve managers actually want and less about what commentators want to project onto them. And the current survey data supports that broader logic. Central banks continue to cite performance during crises, diversification, and store of value as core reasons to hold gold. And a big majority expects global gold reserves to increase further. That matters because it means even the institutions not making blockbuster purchases may still be leaning in the same direction intellectually. Buying often starts in the mind before it shows up on the balance sheet. So, what does this actually mean for you? It means if you want to understand the next stage of the gold market, do not just watch the obvious giant. Watch the smaller tells. Watch who is adding a little. Watch who is revising reserve targets upward. Watch who is talking more openly about security, resilience, or domestic storage. Same asset, different interpretation. The giant countries tell you about power. The smaller central banks often tell you about preference. Here's a question for you. Which do you think is the bigger signal for gold? One giant buyer making a splash or a dozen mid-sized buyers moving quietly in the same direction? Drop that in the comments because I read them. Because I think a lot of people underestimate how important the second one can be. Now here's a simple action plan. No drama. Step 1. Stop consuming central bank gold news only through the usual headline countries. Build a habit of watching the broader official sector list. Step 2. Focus on pattern, not spectacle. Are more countries adding than reducing? Are purchases geographically broad? Are reserve share targets moving higher? Step 3. If you are expressing this view through gold or gold equities, remember, broad official demand is better for the metal's structural floor than it is for every miner automatically. Do not make the common mistake of confusing demand for gold with effortless returns in bad mining businesses. Step 4. Keep it sane. Gold does not need leverage to be exciting, and a slow institutional bid can be more powerful than a loud retail panic. Now let us map two plausible paths without pretending we can predict the exact candle. Path 1 is the broadening floor path. In this world, the long tail of smaller and mid-sized buyers keeps growing. Reserve managers continue to normalize higher gold allocations, and the market gradually accepts that official demand is geographically widespread and structurally sticky. That supports gold even without a giant single country shock. Path 2 is the wake-up path. In this world, the market keeps ignoring the smaller buyers until another larger player moves. And only then does everyone suddenly notice the pattern that had already been building underneath. I am not predicting it. I am saying it is within the set of things this market is capable of doing. Now, here is the uncomfortable truth. Markets often wait for a celebrity signal before they respect a trend that has been obvious in the smaller data for a long time. Institutions know this. They can move quietly while the crowd keeps waiting for the dramatic headline. Retail investors, meanwhile, often ignore the subtle build until the big story finally lands and price has already adjusted. That is why a defensive strategy matters. Not because you need to chase every central bank update, because the long tail is often where the real structural story becomes visible first. 1. Decide your maximum allocation first. Write it down. And if you're losing sleep, you are too big. 2. When something runs hard and you are up a lot, take some off. Not all sum. If your position doubles, consider trimming half. Lock in the original bet. Let the rest run. 3. Do not use leverage or confuse narrative with mechanism or keep all of one thing in one place depending on the topic. 4. The best time to buy is not always when you are most excited. The best time to buy is when you can still breathe. So here is what we covered. The smaller central banks matter because they tell you whether the logic behind gold ownership is spreading beyond the obvious giants. Recent official data shows a broad, long tail of buyers, not just one or two headline countries. And when many reserve managers across different regions keep reaching for the same asset for similar reasons, that is a stronger signal than most people realize. The mechanism is doing something that most people do not see or will not understand until it is too late. Stay alert, stay thoughtful, and do not let headline country bias blind you to what the quieter institutions are already showing you. Now, here are my questions for you. Do you think the small and mid-sized central banks are a better forward signal than the giant reserve powers? And when you watch official buying, do you focus more on the size of each purchase or the breadth of countries participating? Drop your answer below and remember to include what day and date you are watching from. If you got value out of this, subscribe and comment Fin Talk OG, so I know you want to follow up on the quiet reserve buyers, the countries to watch next, or how broad official demand changes the long-term gold thesis. All right, stay sharp and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.